Something has just occurred in the stock market that we haven't witnessed in 50 years. The last time this exact combination of events took place, the majority of investors panicked and lost everything. Many fell into the traps we will dissect today. Conversely, a select group of people quietly built generational wealth. That was half a century ago, yet today, between 2020 and 2026, every piece of that historical puzzle has snapped back into place, almost exactly as it did before. The question isn't whether this is happening, but rather on which side of history you intend to stand. I want to be clear, I am not here to fearmonger, nor am I selling gold, crypto, or any specific product. My goal is to present the data. We will walk through the events of 50 years ago, compare them to our current landscape in 2026, and identify exactly what the most successful investors did differently. The people who flourished in the 1970s and 80s were not necessarily the smartest, they were the most prepared. By the end of this video, you will understand what they saw, why their strategies worked, and how you can apply those lessons today. To start, you must understand a rare economic phenomenon known as stagflation. It is arguably the most challenging environment for any economy, defined by three simultaneous factors: rapidly rising prices, a slowing economy, and a deteriorating job market. It is dangerous because the standard tools used to address one issue often exacerbate the others. If the government lowers interest rates to stimulate the economy, inflation spikes. If they raise rates to combat inflation, the economy stalls, leading to job losses. The U.S. last faced this specific deadlock in the 1970s. Why am I raising this now, in April 2026? Because every ingredient of that 1970s crisis has returned, and some have already taken hold. To grasp the gravity of the present, we must look at the past. It began in 1971 when President Nixon took the U.S. dollar off the gold standard. Before that, every dollar was theoretically backed by physical gold. Removing that link meant the Federal Reserve could print money without a hard limit. As government spending surged and the money supply expanded, too many dollars began chasing the same amount of goods, the textbook definition of inflation. Then came October 1973. The Yom Kippur War broke out in the Middle East, involving Israel, Egypt, and Syria. As the U.S. and its allies supported Israel, Arab OPEC nations launched an oil embargo. Oil prices quadrupled overnight.
Because energy costs are embedded in everything from food production to transportation, this oil shock sent inflation soaring. By the late 1970s, inflation averaged over 7% annually, occasionally peaking above 13%. To fight this, the Fed raised interest rates aggressively, with the Fed funds rate exceeding 20% by 1981. Mortgage rates hit 18%, businesses stalled, and unemployment reached 11%. That was the chain reaction: money printing, followed by an oil shock, stagflation, aggressive rate hikes, and ultimately a recession. Now look at 2026. Step 1. Money printing. After COVID-19 emerged in 2020, the U.S. government and the Fed took measures identical to the 1971 playbook, printing trillions to prevent collapse. The Federal Reserve's balance sheet surged from $4 trillion to over $9 trillion in 2 years. Consequently, by mid-2022, U.S. inflation reached 9.1%, the highest in 40 years. Step 2. The oil shock. In early 2026, military tensions between the U.S., Israel, and Iran led to the blockade of the Strait of Hormuz, a narrow waterway that handles roughly 20% of the world's daily oil supply. Oil prices spiked past $100 a barrel, with spot prices hitting $141 at one point, the highest since 2008. Just like in 1973, this shock hit the cost of fuel and everything it powers. Step 3. Economic decline. In February 2026, the Bureau of Labor Statistics reported 92,000 jobs shed in a single month, with unemployment rising to 4.4%.
Meanwhile, core inflation remained at 3%, well above the Fed's 2% target. Market experts like Eddie Yardeni have pegged the odds of a 1970s-style stagflation scenario at 35%, a significant 1 in 3 chance of the worst economic environment in half a century. Step 4. The Fed is paralyzed. Just like 50 years ago, the Federal Reserve is in a trap. They cannot easily cut rates to stimulate the economy because doing so during an oil-driven inflation spike would only accelerate price increases. Yet raising rates risks triggering a deeper recession. As one chief economist noted, the combination of huge budget deficits, stubborn inflation, and $100 per barrel oil creates an impossible position for policymakers. This is why this is a 50-year event. The data lines up piece by piece. Now, consider the investors of the 1970s. Take 3 individuals who each invested $100 a month starting in 1971. The first invested in the S&P 500. Over 10 years, their $13,200 grew to $21,500. While that sounds like a gain, inflation over that decade was 124%, meaning their purchasing power actually declined. The second kept their money in a high-yield savings account, which paid well at the time. Their $13,200 grew to $20,000, which still failed to keep pace with inflation. The third was the opportunist. They bought gold. Their $13,200 grew to $45,500, a 245% return that crushed other assets. However, the story changes over 20 years. By 1991, the S&P 500 investor grew their money to $133,000, finally outpacing inflation. The savings account investor ended up with $60,000, failing to beat the long-term rise in prices. The gold investor, surprisingly, ended up with only $52,000. Gold is a fear asset. It thrives when there is uncertainty, but falters once the Fed curbs inflation and the dollar strengthens. The lesson is clear. Investing is not just about picking an asset, it is about understanding the reason behind the movement and knowing when that reason no longer applies. This is the trap for 2026. The 1970s did not have AI, a total reshuffling of global supply chains, or a massive restructuring of energy infrastructure. If you play the 1973 game in 2026, you will miss the opportunities. Smart money is currently shifting toward energy, critical minerals, and AI infrastructure. First, energy. When oil prices surge, energy companies that produce, refine, and transport fuel do not suffer. They benefit. The U.S. is now the world's largest oil producer, making domestic energy firms more profitable than they were in the 70s. Second, defense and aerospace. Given current geopolitical conflicts and rising global defense budgets, these companies are seeing unprecedented government investment. Third, the physical backbone of AI. AI needs more than just software. It needs data centers, cooling systems, power lines, and vast amounts of electricity. Companies that provide these physical components are the ones benefiting from the AI gold rush, regardless of which software wins. Finally, there is a broader shift toward hard assets, energy, copper, steel, and minerals over paper assets. The investors who lost in the 1970s did nothing, thinking that holding cash kept them safe. But safety that doesn't beat inflation is merely slow wealth destruction. The winners were those who understood the economic environment and recognized where the pressure was forcing capital to flow. The pattern isn't identical, but the logic remains. Identify where economic pressure creates demand and position yourself before the headlines catch up. You don't need to panic, but you do need to pay attention. Look at your portfolio. Does it have exposure to energy, physical infrastructure, or real assets? If not, now is the time to ask why. We don't know exactly how this plays out, but history suggests that when these ingredients are on the table, you should be proactive. Preparation is not panic, it is simply being alert enough to act before the opportunity disappears.